What's up, guys? Another Trade Genius podcast here with Bob and Phil. Guys, it is full tilt at the casino. Leverage is all-time highs. We've got stocks up, crypto up, but guess what? Not for long. Let's dive in.
Trade Genius.
Hey guys, we got Black Friday specials. They're really cool. We have the best pricing for the year. You can get our basic package, our advanced packages, our VIP rooms, software, trade options, trade crypto, trade the futures. With us, get our indicators, best prices of the year. Take advantage of it. Thanks for listening.
Bob, I'm hearing more and more that the market can never go down again. And I get flashbacks to August of 2022 and July of earlier this year. What say you?
What I'm going to tell you, Phil, is that systematic destruction of all asset classes have already begun. So, they started with oil and then they just took down gold. Okay. Earlier, they took down people that were hiding out in the bond market. And over the weekend, now they're starting their work on Bitcoin. And in another 4 to 6 weeks, they're going to take the rest of the asset classes down. And the culprit here is all around the derivatives. And I mean, this is really, really clever what they're doing. They're doing what's called stock replacement with options. They're basically peeing on you and telling you it's raining. And here's the chart I want to show you guys now. This is just amazing. This is the amount of leverage that they're pumping into the option market right now. And so what you're able to do, and I was telling you guys this morning, I said, look, I personally control $225,000 worth of SPY, and I'm doing it with $2,000 worth of calls. I mean, that is insane amount of leverage. And do I care if I had SPY and I made 20% for the year? Do I care if the last $2,000 blows up on me? I don't. So the people you have to worry about are all the people that now are owning the shares that the big money has owned that now have transferred into call buying, okay, or put selling. And so they're out of the market. They're probably 80% out of the market, and now they're just dabbling with options. And this is unsustainable. And now you're starting to hear, well, this is secular. Whenever you start hearing things are secular and things can't happen, then the move's pretty much, getting to the end here. And we know the flows into February, March do not match the flows in January. So when you have that change of direction or amplitude, the market can't help but also have that giant sucking sound down. And so that's one thing I want to show you is on the option side. Now, somebody did a great line this morning on Twitter X, said basically Main Street is not having the same party as Wall Street. And you know why, Phil? Throw up this next chart. Because they're spending too much damn time working. Look at this.
Yeah.
This is what people have to do to absolutely survive. It's just amazing to me.
Yep.
And so we're really pushing ourselves against the wall here. It was really interesting to me, though, to see Bitcoin get that hit that it did. We're used to seeing gold take these early morning takedowns. Now we're seeing the Sunday evening Bitcoin takedown because we've been pushing up pretty hard, and everybody's thinking that the way Janet Yellen's operating, but they keep forgetting, Phil. They keep forgetting that Janet Yellen's going to have to pivot from T-bills to T-bonds here pretty soon.
Sure. Yep.
And there goes all your collateral.
Yep.
This next chart I want to put up there, but I want you to talk about it, and then I also want you to talk about Bitcoin. So if you don't mind, throw this chart up. This is the volume profile.
Well, hey, Bob, real quick before we switch to that, this job,
Sure.
multiple job holder. I mean, look at what we're doing here going into 2024. I mean, look how far back this goes. This is a deteriorating situation here. This is not what you would consider to be healthy and an economy that's supposedly growing GDP like gangbusters. You should not be seeing multiple job holders, secondary job, part-time hold. Like this is like everyone's trying to get as many, Uber side jobs as possible to pay the bills. This is, Fed is failing. The government's failing. This is not a healthy consumer base.
Yeah. And Phil, goes just like they do stock replacement. Companies are only hiring part-time because they can jettison them too.
Mm-hmm.
So everybody has a foot out the door, except for the knowing bros, right? That are pumping every day. Because look, you could just, if you have a bunch of part-timers, you could just blow them out the door in a heartbeat. And I just feel bad for people that have to have a part-time job just to pay the bills because it's just getting worse and worse and worse.
Yeah, and plus too, there's medical implications too to mandatory medical for employers. So if you're under, I don't know what it is, I guess it varies by state, but some places will be like 20 hours a week or under, they don't have to give you medical, right? And so there's ways of cutting costs. Let's get a bunch of part-time guys versus the full-time guys, because I think that's another thing that's happening too, because all these companies are in cost-cutting mode if you look across the board, and so we're seeing a deterioration in full-time jobs. We're seeing companies trying to cut costs left and right. We're still seeing WARN notices, right? WARN, which the bigger companies have to issue when they're having mass layoffs. So I just, this is not something you see at the beginning of a bull market.
No, absolutely not. And let's flip on to this next chart, because this was, I wasn't going to put this in there, but this kind of blew me away, because where we are right now structurally, we have a call wall at 460, but then also there's some other volume profile things saying, hey guys, ring the bell here, and I want you to kind of explain what we're seeing here.
Okay, so on the left is a volume profile, which is, instead of having volume at the bottom of the chart, like you see with the histogram at the bottom of the chart, this is a histogram on the side of the chart. And that's helpful because it shows you at what price most of the volume occurred at. And you'll find that if you draw lines across the way, that we get support at those various peaks and troughs in that side histogram there on the left. But what Bob's asking about is at the top here, we're getting into this low volume area. And what that is that's on top of the value area. So value area is like call it the 80% area where most of your volume occurs if you're looking at a range. So that's what's highlighted there. The dark areas are outside of that. So typically what you would expect is that if you are going to venture into that, outside the value area and into that upper zone where that ultra low volume zone is, you better start turning that into support, because what invariably will happen is if you don't and you lose that level, which we're pressing up into now. So let's say we do get our push into January. Let's say we even take out the all-time highs. Totally possible given the flow situation right now. But if you fall back under the level we're trading at here now at the SPX, back under 4,600 SPX after doing all that, you're going to probably trigger a very large move back down. So if we move into this upper bound, which I think we will going into the middle of January, you best not fall back under 4,600 SPX, because if you do, that's a classic look above and fail. And then the range rule applies. What's the range rule? You fail the top of the range, you're going to go back and visit the bottom of the range, and you can see how far down that is. And so then you have to start looking at the macro situation at that point too. So there's definitely the ingredients here for a final push up and then a larger broad pullback going into the middle of the next year. And then does that fall into, recession? And then the yield curve goes positive on the 2-year, 10-year yield curve. Does that go positive? If all that stuff starts to happen, then, we could be basically down and not looking for a resumption of the bull market until Q1 of 2025. If it's the 3-year, 10-year curve, that would imply Q1 of 2025. If it's the 10-year curve, that's right, then that's actually as late as Q3 2025. Nobody, if you told people that right now on Twitter, they'd all think you're nuts, right? So everybody's looking up, and meanwhile, we're going to be warning you that that might be right in the short term, but long term, you have a lot of downside risk ahead over the next 4 to 6 months.
Yeah, and the only thing I would say to people is, while Phil gets his Bitcoin chart set up, is that, look, you don't have to go hog wild short here. You can let price come back inside the value area, because once it does, Phil's right, man, it likes to go from one end of the range to the other, and you can layer on some longer term, short hedges here. I'm still in the camp we're going to hit 480. And, I have a 503 target out there too, which I'm not as confident about, but I just take my trade every day and just move up my call as it's moving higher. But the thing about these moves is it's a 2/3, 1/3 room too. So if it took 2 months for it to get to the top, it's only going to take 1 month for it to get to the bottom. And so people just need to be prepared that this thing can whoosh on you. And as long as it stays above the point of control where you set line going all the way across, big money doesn't care. It's just a pullback. So, you might think it's the end of the world. They just think it's a pullback, and they took profit off of you because they replaced all their stock with options. And they're thanking you very much for setting them up for another really great year in 2024. Right. You are the sucker at the table. Right. So, and the suckers at the table are the people all with mutual funds, financial advisors, telling people to stay the course, yada, 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 don't raise cash. And they're the ones that are going to be paying the bills on this one when you're finding yourself down 20, 25% here between February and April next year.
Right. Yeah. Yeah, so let's switch over to Bitcoin because that's been doing some crazy moves. And I know everybody's probably going to want an update on that. So basically, guys, big picture, right? All-time highs back here, bear market deleveraging event from Luna to FTX, and basically just a quick drawdown. We did not get a very long bear market like we've seen in the past, right? Like we've had, usually these things trough out for a while and then we get our post-halving bull run. This was 2019, so you could say that this drop into here and this pop here is similar to 2019. Typically before the halving, you do get a rally and then a pullback. This was exacerbated obviously with COVID on this low here. Otherwise, I think we probably would have stayed up, in the 6,000 to 7,000 area. So, that's always a risk if you have a black swan. But I think this one, maybe not so much a black swan, is that we just have a recession and this thing kind of draws out. So you could see where we get a lower high. If we do go into the recession, I don't think Bitcoin is just going to ignore and shrug everything off. I think we're going to pull back down. Where Bitcoin's going to take off and along with gold is when they give up and throw in the towel and they start printing again. It's going to make this look tame back here. This was just like a test run. But big picture now, we've gone up like every cycle that we've ever had. We come up, we retest the cycle highs from the lows to the highs, the 50% to 618, right? Sometimes they'll call that the golden fib zone or whatever, but that is, that's basically where we're looking for this move to kind of peter out and then pull back. Now, obviously 31K and 25K are big support zones. So you're looking for those levels to hold. If we get recession, I think we take out 25K and we have a gap. Now, what you have to keep in mind is the CME futures now has more open interest than Binance does in the futures market, which is a shift. Now the CME futures is carrying more weight. And that matters is because we have gaps in the CME futures chart. And so what are gaps? Well, Bitcoin trades 24/7. The traditional markets do not. So CME futures, their Bitcoin futures don't trade over the weekend. So we still have gaps, much like you do in stock charts and things like that because of weekend and overnight moves. So we've come down, we touched the top of this gap that we established from the other week when we bolted above 40K basically and gapped and goed, right? Well, looking for this gap to fill, we also have another gap down at towards 34,400 on this chart. Right now, these futures are trading at about a $300 premium over spot. So what that means is we probably would see if this gap closes, we'd probably see 39K print in the spot markets like on Coinbase. If we go into a larger pullback before we do that end of month rally, end of year rally, we could, because this is Bitcoin now, right? No move is too big. You also have a spot down here at 34 and change that fills this other smaller gap. These gaps tend to fill on the CME futes. They're pretty powerful when you start getting into vicinity. And if you look at the liquidity chart here, this is kind of showing you where the hot zones are for where liquidations will occur. So this upper one is where that upper gap would fill that I just showed you guys. That would take care. If these liquidations get hit, you're probably filling that gap, and then we'll probably get a pity bounce back up. If there's a larger move in store, we're going to break below that gap level. We're going to break below 39K, and you have to watch this concentration of liquidity down here at 35K. That gets that lower gap in the CME. So I would be open to all that. And the reason why too is we have seen twice now, we've had 20% pullbacks on this move up when we've gotten over our skis on Bitcoin, and 20% pullback from the highs at 45K would take us down to about that lower level. So be open to this being totally doable. Also be open to a pretty aggressive bounce that I would say would probably coincide with equity markets. And that's going to be like your final hurrah. And then we're going to see, after January, the liquidity should start to dry up because like Bob alluded to, Janet Yellen has kind of already shot the load on the bills, and the bill liquidity is going to dry up. And that's very, very bearish for liquidity flows as she's going to have to concentrate on the long end of debt issuance. So on the 10 years, the 20 years, the 30 years, and the market's going to have to eat that up. And that always sucks out short-term liquidity out of the markets. Then you're going to see the net liquidity on the net liquidity graph drop. And highly unlikely the market is going to just shrug that off at this point because you could get away with it for the last 6 months with the T-bill issuance because it wasn't as extreme as it was now. But basically, that's done. And they can't go any further on their T-bill issuance or we will default on the debt. So they can't, their hands are tied, and that's all they can do now.
Yeah, and 3 points here. One is that if Bitcoin does do a 20% drop, you're going to lose 80% of the gains that you got in Mara and Riot over the last couple weeks.
Yeah.
So you might want to take some profit there. I mean, you're already saw Wolf gave back, almost 15, 20% today. So, just so you know, those things are very, very, very volatile. Number two, Phil talks about this stuff in his crypto room all the time. If you guys want to trade crypto with us, and you get the benefit from him paying very close attention to that, and the last thing that I want to talk about was, Phil, I'm going to turn that back to you because it's really, really scary what can happen to the miners here at the halving.
Right. So what you guys have to understand now, I know miners are a great play. They're highly leveraged plays. They're a highly leveraged Bitcoin play. The moves on them are outsized in percentage terms. And I think, long term, I'm very bullish. I want to allocate into that in the portfolio, but I don't really want to do that until we get through 2024. And the reason is hash rates at all-time highs, guys, and it keeps growing week after week after week. Why that's an issue here for these miners is that, and you can see Wolf had a big pullback here on this. A lot of these guys are tied to the price of Bitcoin. Mara and Riot, same thing. But what you have to remember is that the cost of mining a Bitcoin is going to double after April, right? Or halvings in April, it's going to double. Why? Because they're only going to make half as much Bitcoin for the same amount of work because the reward gets cut in half. It's in the code. It's not changing. That's just a fact of life. So cost of Bitcoin right now to manufacture or mine, depending on who you are, I think Riot is on the very low end of the spectrum, just above 10K or so. But most of these guys are looking at Bitcoin costs that are somewhere between 15 and 20K per Bitcoin to mine. So let's just say it's like 15 to 18,000 on average. Well, now you're north of 30K to mine one Bitcoin. That's going to be your electrical costs and everything else to mine one Bitcoin. So if we go into a recession, if we go into a pullback, broader pullback, if the stock market takes out its 2022 lows, Bitcoin's likely going to be trading under 30K unless the whole world decides to buy all the rest of the Bitcoin up in the exchanges. But realistically, that's not how the market likely is going to work. So is it going to pull back with the rest of the risk on assets? Most likely, right? 98% chance that's probably what's going to happen. So we're going to be under 30K in that scenario. These miners are going to be hemorrhaging cash. So unless they have a big cash buildup or a big Bitcoin reserve, that war chest is going to have to come into play to keep them afloat. Otherwise, if their debt isn't structured properly, these guys are not going to be able to make it and they're not going to be able to cash flow unless they get an infusion from, somebody like BlackRock or something like that to get them through. But all I'm saying is that these guys, if they are under their cost to produce, if the price of Bitcoin is under the cost to produce, what we're probably going to see is a hash rate reduction. That's going to what we call the hash rate capitulation. That's usually a sign that we're in for a longer term pullback in Bitcoin. So we want to be eyeballing that as we progress through the halving, because the rate at which the hash rate has grown to secure the Bitcoin network is exponential. I mean, it's just parabolic right now. And I think it sets up, it's very ripe, unlike other halvings. This halving is very ripe for a situation where you could see a lot of miners have to unplug because the cost to mine Bitcoin exceeds what the price is going into 2024. So that's just a big warning there on some of the, I know some of these are going to look really attractive. They might look way more attractive in the middle of next year.
Phil, why don't you explain what hash rate means for those who may not be familiar?
Yeah, so let me pull up the hash rate chart. All right, so Bob, this is the, and for you guys out there, this is the hash rate. This is basically the computational power of the network. So as more miners come online, let's say, you're a commercial Bitcoin miner, you want to bring on more hash power. Why? Because you want to mine more Bitcoin, right? The Bitcoin rewards more hash power because the more hash power you get, the bigger slice of the mining pie you get, the bigger slice of the reward pie you get, right? So you incentivize to bring on as much power as you can. Well, the problem is that as this goes up, so does the cost to mine one Bitcoin. And the reason for that is that the Bitcoin network is kind of a self-maintaining network in that it is always trying to regulate that the rate of production is one Bitcoin reward about every 10 minutes. Now, it's not exactly 10 minutes, it's an average. But if a ton of hash power comes on the network, let's say in a week or so, then what it'll do is it does an evaluation, self-evaluates every couple of weeks, and it says, oh, we're mining too fast. We got to increase the difficulty rate. And then it makes it more difficult to mine one Bitcoin because it's trying to temper the amount of Bitcoin that is produced to every 10 minutes. Okay. So the more mining hash power that comes on the network, the more difficult the network makes it because why? It's trying to pace the rate of inflation of Bitcoin. Bitcoin, right? So Bitcoin's being created every day. That's inflation. Even though it's a disinflationary asset, I don't want you to get confused. It's a disinflationary asset, meaning that the inflation rate reduces over time. It's a very unique commodity in that respect, but it does inflate every day. So it's trying to pace that inflation rate. And that was because the creators of Bitcoin could think, if a ton of hash rate came on the network, then you'd be, the inflation rate would be all over the board. You'd have spurts of high inflation, spurts of lower inflation. They were trying to keep that constant, which is actually a really elegant solution to the code. So what's going to happen is you see back here, we have these little areas of red, right, Bob? That's where the price of Bitcoin fell and it got too expensive to run miners and they had to unplug. And so you get what we call the hash rate capitulation. And that's where now, if you look at the price of Bitcoin in relation to those, where these events happen, so these little bubbles represent where that happened. You notice the price of Bitcoin, that's not bullish for the price of Bitcoin. When you have these signals, typically Bitcoin price is going down. And, I'm in the camp where price dictates hash power. So, miners are going to chase the price of Bitcoin, not the other way around. So if Bitcoin, for whatever reason, pulls back or it's risk off, then the miners are going to be forced to power down. And that's also a confirming signal. But where it's really bullish is when you get out of these troughs, and then you'll notice these blue areas is when, the storm is past, the hurricane is past, and now you're back to appreciating. You notice the price of Bitcoin appreciates. And then what happens? You get miner signaling that they're out of the capitulation phase. Boom. Look at this over here. Same thing. Out of the capitulation phase. Boom. And so we're going to get this again, and most likely. And every time we come out of these capitulation phases, it's generally a bullish thing, especially if it happens after the halving, which I think is what's going to set up. So we want to be careful for when this crosses again. If this was the high of the move, because we did the 50 to 618 retrace, right? If that's the high of the move, and we could try to test the highs one more time. But if that's pretty much it, and this thing over the next 6 to 8 months rolls over, this will capitulate. That should be a buying opportunity. And then when that thing turns, when we get the blue signal again on hash rate post halving, that's going to be a monster buy signal for Bitcoin. So I think that's kind of what's going to play out, and that's how hashing and mining and all that stuff, it plays out. But this is the problem, back to the issue that we talked about for miners, this stuff here. Because if you don't survive that, you're going belly up. Somebody's going to come in, buy your mining equipment, and you're done. And I think we are going to have a war of attrition here if we get that capitulation on the hash rate. And we'll see who survives. But that's why I said, Bob, you want to wait really through 2024. Whoever survives 2024, I think major returns forward looking on those stocks.
It's amazing, Phil. I wish our federal government would do currency this way.
Imagine that, right?
Yeah. Hey guys, thanks for listening. Hit like, subscribe, notification, come trade with us. I think we're in a pretty good groove here. Just watching them blow up these asset classes one by one, and they're replacing stocks with options. So don't be surprised one day you're going to wake up and, the market is just ripping down because the boys have it all set up for themselves. And we can see the whites of their eyes now. We're less than a month out in terms of that event having an end date. So anyway, you guys have a good one. We'll have some other really good stuff for you this week. And with that, enjoy the day.
Trade Genius.